All right. Are we live?
We're live.
All right. Welcome to the AIM Fall 22 Pitches, dated November 11th. A little bit different this week. We have walk-in intro music, much like the NBA does, right? We've got superstars presenting each week, and so something new we thought we'd add on, where it's almost like we're on the tropical cruise ship AIM, is walk-in music. Today, we're happy to have Mr. Jake Bernarde with us. And Jake's going to be walking us through his company, kind of how he found it. In particular, as you know, as we start to morph AIM, the AIM model, we're going to be really interested, Jake, in particular, a couple things. And you can either get asked the question as we go, Bennett, or you can start off with it. But either one, all the mentees, I'm going to hit you up with some version of what's the revenue driver, what are you seeing as a moat? And then I really want to know what you did to kind of go outside the box, make these things special. And I think we actually have a lot of buys being pitched this week. Are you pitching a buy?
Yes, I am.
Hallelujah. I'm looking forward to this.
Awesome. All right, hello everyone. My name is Jake Bernarde. I'm senior in the program, covering international consumer staples, and I'm here with Bennett Barr, my great mentee. Today we'll be pitching Sendas Distribuidora, aka ASAI, which is their native name in Brazil. And we have a price target of $23.60, which represents an upside of 30%. And this price target is up from what I have in the write-up because when I was first modeling the company out, I had about 40% of upside, but then the stock ran up from about 17 three-ish weeks ago to 20 last week. And then that was after the announcement of third quarter results and kind of the outlook for the company. And also, then this morning, the company's trading at about $18, which adds some additional upside, obviously. And this kind of slide in the share price was due to overall market conditions in Brazil. This was the presidential election last week and kind of that, or 2 weeks ago. So that's kind of what I got. Ready for questions, unless you want to dive into a question right away.
Yeah, I can address what Dr. Hall was talking about. So first off, our revenue drivers. I think Jake will get into this too, is just in terms of store expansion, that's really what we're basing our upside over the next, our forecasting for 5 years is a really cool thing though. So for revenue drivers, I was looking for a way to effectively and efficiently kind of put a value on this. So two revenue drivers is looking at revenue per employee. So at each of these new stores, if we can maximize and make it efficient in terms of the revenue per employee, we saw that as a big driver, as well as revenue per square foot of these stores, given that they operate in this brick and mortar sector, and just how important that is to our overall company growing overall. Basil, do you have a question?
Yeah, so I know you talked about revenue drivers and everything like that, but what's the expected growth rate of opening up stores?
Yeah, so they actually recently acquired, I think Jake will get into this as well, but they got 70 new stores from Extra.
Okay.
So then they're converting those to their cash and carry industry from what they originally were, kind of like a supermarket approach. So that's the conversion of those stores is a big thing, as well as just kind of organically growing as well within that Brazil market throughout various geographic locations they see as a benefit.
Yeah.
So
great job.
I'll pass it off to Jake.
Yeah, I'll add on to that. So as you know, in my write-up, talked about that, like Bennett said, the Extra transaction of 70 stores. So those will be finished by about mid-2023 of that fiscal year. And then kind of the whole scenario, or I guess the driver, is my initial analysis with this, with the store growth analysis with organic stores. And so specifically fiscal year 24 through 26, I have 28 organic store openings, which is 12 above consensus. And I guess a key point of this is I did kind of Dr. Valentine's analysis of the thresholds for materiality, and I found that it only took about 5.5 stores, so I guess 6 stores for it to be material. So that includes about a $1.6 billion top line growth, which adds to EPS by 4%. And then going off of that, with this midterm growth for stores, it's important to note that I also added. So I found that the street was kind of cheating it. So either they would say they're going to have these organic growths or not, and they're not factoring into CapEx. So basically, they get the upside of the additional stores without having the additional expense related with it. So that's where I say I'm 11% and 9% above consensus for CapEx in fiscal year 24 and 25. So yeah, August.
First, I just want to say I think this is one of the most detailed write-ups I've seen in a long time, and I really like the expansion analysis part of your write-up. Bennett, you mentioned efficiencies revenue per square meter, and I noticed that between now and 2023, they go up from like 0.048 to 0.06. Is that like a 25% increase? Is that like a really big deal? Like, what is driving the efficiency in the next year for them?
Yeah, I think the biggest thing is this conversion of these stores with that acquisition from Extra we're talking about. So that's where they get these 70 stores that they're converting from kind of a supermarket approach to this cash and carry industry in which they operate. And just in terms of efficiency, the more that they do, the more they learn. And I think that's just really driving it. And the more stores that they have, that also goes to that benefit. Does that help?
Yeah, I'll add on to that a little bit. So the one thing I found, which is pretty cool, is Morgan Stanley, ironically, is the leading company for the top price target. They're at 27, so I'm quite a bit below that. But what I found was they did a really cool proprietary research on, like, they mapped out over 1,100 different stores in Brazil, and they determined, this is how I piggybacked off that with my estimates as well. With these Extra stores are in locations that have 6% higher GDP per capita, and also the populations are 30% higher. And on top of that, stores are about 10% bigger on average, so they have all these extra SKUs they can add in, which adds to overall volume and variety of products. And then along with this, only 4% of these stores would overlap within a mile of the current footprint of the company, so there's very low cannibalization risk with that, which is important. And also, same is true for Avocado, who's the biggest competitor. They're only about 4% within a kilometer or kilometer of those locations. So. August?
I'm just curious, like, what was your screening process to find this?
Yeah, so actually originally I started out, I wanted to look for a retailer in the international segment in consumer staples, just because we have no representation there. All the companies we own are like producers of products. So I started with a Canadian company and just kind of found in my screening process and kind of running through them, we didn't have there's no upside really. Everything seemed to be kind of priced in. So we found this company through our process of looking just for high growth, and especially in a young emerging market like Brazil. I know there's going to be some volatility, but I think the overall story there is strong, especially as they're 100% in Brazil and they're 100% focused on this cash and carry segment, which is going to allow them to so compared to their competitor, the biggest one, Avocado, as I mentioned, they're doing business in other segments, so they're not really able to focus on the same level of growth as ASAI or Sendas is able to. So,
Yeah, Grace, Bezel, whoever.
Yeah. So I know that former President Luis Silva won.
Yeah.
How does this affect kind of your margins, especially like your forecasting? Because I understand his political views is kind of different as of right now when it comes to economic growth.
Yeah, so like I said, that's kind of been the volatility in the markets overall. But
yeah,
in terms of, I guess, gross margins, I wouldn't say I factored it in directly, but I mean, in terms of that risk I put in my WAC, I have a 2% premium there.
Okay.
But on top of that, I found, and I did some research on this, obviously, with the presidency only 2 weeks ago, and found that Lula and the last president, Bolsonaro, are similar on their fiscal policy. And that's what at least economists believe. But they're very different, like far left, far right on their social policies.
Right.
So it's not as big of a threat in terms of like fiscal spending as you might think. But
okay.
That's kind of what I found. So I hope that helps.
Thank you, Jake.
Yeah, Grace.
I was just wondering, so I know you did some like peer analysis. Was there why didn't you use that for evaluation?
Yeah, I just didn't think that any of the peers really were in the same situation, kind of like I said, where Avocado didn't really, well, they're actually the biggest player in the cash and carry segment, or they're very close, but they're slightly bigger. I don't think they really, with their other segments, they aren't able to focus on just that cash and carry segment, where they're not able to just push growth. Like as you see this, I think Avocado acquired like maybe 20 stores last year, where as you saw with in my write-up, they acquired 70 along with additional organic growth. So I don't think they're in the same position to kind of capitalize on the shift, the cash and carry segment, which grew over almost 80% since 2016. So.
Gotcha. Thank you.
Alex, you have a question?
No, Basil kind of asked it, so.
Thank you.
So what did you do to form this? What did you do to I'm going to channel my Dr. Valentine here.
Yeah.
Just listen to his comment, right? What did you do to independently come up with this? In other words, your assertion, my understanding is, and a lot of what's driving value, and you've done some really good work, is that they're going to keep opening stores and the streets miss that, right?
Yeah.
And my understanding is is your mentor is that a lot of that idea comes from the idea that that's what management's done and that's what management's telling you. Did you do anything at all to try to figure that out through some source other than management?
Yeah, so that's kind of, I guess, management's where it started from.
Yep.
And then so I went to all these different sell sides and kind of independently verified. And I just
So
found there was a giant. Yeah,
So wait a minute, if the sell sides all figured this out too, that,
No, I'm saying they didn't figure it out.
yeah, but my point is, right, here's where Dr. Valentine's pushing back a little.
Yeah,
Yeah, channeling. If sell side hasn't figured this out, and management told me that the sky is large. And all the sell side reports say, no, it's green.
Yes.
What else helps me understand it's orange? Like,
Mhm.
outside of management, because management's incentivized to tell you that they're gonna
Oh, yeah.
open a lot of stores and keep growing. Did you do any other kind of research or any kind of
Yeah.
anything to try to verify that they'll keep opening stores and that that is indeed a thing, other than management telling you it's a thing?
Yeah, so first of all, I just want to say that I know I get the management thing, but they have been very accurate on their predictions in the past of
Yep.
growth. So that's just a starting point. But then that goes back to if you look at my write-up in Exhibit 6, that's kind of my whole analysis and where I get this from.
Mhm.
And while I did some analysis of their debt as well, and they're levered up slightly more than they have been historically, but I expect this to kind of then the delever in mid-2023 up to 2024.
So
And then this-
let me translate.
Yeah.
You're seeing a levering up that is beyond what it would take to open currently existing stores. It suggests to you,
Yeah.
why would they take on all this money at high interest rates unless they're gonna spend it on something?
Mhm.
So
Yeah.
split the middle
Yeah.
in future write-ups for Bennett.
Mhm.
Put that in as your lead to research, right? Management thinks this, I've modeled it, but here's why. I went out and independently looked at their cash flows. They built up X amount of hundreds of millions. They have no use for it other than to spend on stores or takeovers. Their history suggests takeovers, therefore.
Yeah. That's good.
Cool.
Yeah.
Yep,
Thank you.
all good. Awesome. All right, thanks. Yeah, now we're getting to these tiny little nuances. This is a good thing, right? Like, now wholesale disruptions. They set a high bar. We'll see how the next one goes.
Go.
Mike, are you sure you don't want to walk out wrong?
That's our next one.
I'm
I
not
am sure. Right. Oh, God. Mike.
Yeah, he's going a cappella, actually. He's going a
Yeah, this is
cappella.
good. Wait, where's your intro? Are you guys gonna sing it? A cappella? Is that what's going
We
on?
are all like naturally.
Like,
You
you
guys
got a
do it
bass
kind
here,
of
you
like
got
a
a drum, you
quartet.
Tenor, you guys gonna go, ah? Yeah,
Okay,
yeah.
smile.
Is that your intro?
This is for who we don't have
Wait,
yet.
Mike, look at the camera.
Bye on 3.
That's the before picture. Yeah. All right, so same deal. Talk us through Middleby. Your two younglings can eventually get us to the point. Oh, totally just botched up. Yeah, your two younglings can walk us through the whole idea of what they think is important for us to know, or we can ask them as we go.
Okay. Well, so first off, I will be pitching the buy of the Middleby Corporation, ticker MIDD. I'll kind of go into my screening process. I slightly changed my price target to $157. They had their third quarter
Slightly?
earnings. Yeah, it's 163. $5. But yeah, so they had third quarter earnings come out Wednesday, and that was kind of driving factor for why I made some tweaks to my model. But nevertheless, I'll kind of go into my screening process. So originally, I was looking for companies that had high variance. I know that was something that Dr. Valentine had put up in the FactSet screen, so look for companies with high variance. And I found this company called Sunrun. They install solar panels on your house, and I thought it was a really cool idea. And I wouldn't say I wasted a lot of time on it, but I spent a lot of time thinking I had something when there were just some very lofty assumptions that probably would not have gone well. So I landed on Middleby really because I thought if I was going to do some sort of alternative research, especially with industrials, I thought it would be a good idea that I could find something where I felt like I could actually find somebody to tell me stuff and I could survey people and do things like that. And I thought that was a very good base. And then kind of going into my change in price target. So the residential segment, their third quarter earnings missed revenue. I want to say by about 15%. And that was really, so in the second quarter, they acquired these grow businesses in 2021. Second quarter, I'm assuming these grow businesses are made in China because they said the China lockdown really had a problem with their supply chain. They weren't able to really get these grows. And then now in the third quarter, they're seeing a lot of inventory destocking by these distributors. So they're saying, hey, we already have enough grows. This really isn't time to be purchasing grows. We're full. So then that's kind of why you see this drop in inventory. So I originally had my fiscal year 23 residential revenue decreasing by 10%, and then I changed it to another 5% drop to 15%, which is ultimately where I get the $157 from. So I guess we'll take questions and
And then we'll hit Tyler and Brandon as we go. All right, Basil.
Yeah, this is the question for the mentees. Middleby's main economic moat is their intangible assets. Illinois Toolworks' economic moat is its intangible assets. Dover Corporation also has economic moat of intangible assets. That's great. I noticed that all your companies have high levels of debt, and I assume that's from acquisitions, correct?
Yeah.
Okay. How many companies or like how many acquisitions has each company done, and what is their strategic moat or what's Mid's strategic moat that's like compared against your peers?
The thing that Mid is doing very different from the other ones is it's been acquiring so many different companies across the different cost spectrums. So they have low cost companies that sell like maybe ice makers that are at a low cost and ice makers that are at a high cost, which is very different from what the other two are doing. Additionally, Middleby, this is like their exact like business, like they are in the cooking industry. Well, Illinois Toolworks, they're more into the automotive industry. That's their second biggest segment, and Dover is more into the hitch and wrench business. So those are kind of the reasons that it differentiates. Anything to add?
So my question is more along this acquisition. I think I'm misunderstanding something. So they bought, you're guessing, some Chinese companies.
well, they manufacture them in China. So
Okay, but so they make their products in China, and they bought some companies in China to be able to sell more stuff, right?
Correct.
And they sold on dollar basis 15% less stuff than you thought. Is that right? Is that what I heard you say?
consensus, yeah, I had 262,
And what they sell, what did they actually come in at?
221, I believe.
And had you factored in these acquisitions in your 262?
Well, so I guess just with the entirety of the model within fiscal year 23, that's why I think there were a lot of questions regarding how my revenue assumptions work, because you see this kind of steep drop off. The way they factor in their acquisition revenue, and I have it broken out in those boxes, is they'll keep them as within for a full year where they buy them. So that's kind of why you see the 4.5%. So all things being equal, if you
Because normally I would expect, let's say a company makes $100 in revenue, and I buy another company, and even if that company shut down for the whole year, I still make my $100 in revenue. I should be making my 100 plus.
I mean, so they did step up if you look from the third quarter of 21 to the
Okay,
third
so it's a
quarter of 22.
15% miss on the growth, not a 15% drop in revenue.
Correct.
Thank you. I haven't looked, so.
Okay.
Yeah. Okay, that helps. You guys did a quarter by quarter model too, right?
Correct.
So
Up-
one thing,
Up until, I guess, so for.
yeah, in the most recent.
Correct.
So one thing they did that we kind of expect seniors to be able to do, juniors, is by the time you're pitching your senior year, we like to see models that go year by year, but certainly in the last year at a minimum, switch over to quarter by quarter. That helps you more fine tune for some of the events that we're talking about, as opposed to having each year impact. So I appreciate the attention to detail on that. August.
Yeah, Basil alluded to like the amount of debt that Mid has. Do you know how much that is variable, and like, you know what the effect would be if like rates rose on EPS?
Yeah. I didn't really go into EPS. So I did increase my percentage of revenue. So I guess just to go back. So for my WACC, I used 4.5% for my cost of debt. And then as for fiscal year 23 and fiscal year 24, I made it a higher percentage of revenue just because I don't know where rates will go. But I think as long as I increase them, I think that captures it. With regards to kind of how the debt is, so they have really just bank debt. So they have a revolver and a term loan, and those are floating. But they purchase, I believe it was like interest rate swaps, if that's right. So it kind of eliminates these like a lot higher.
What year do the
increases.
swaps expire? Are they
24?
okay?
I believe, correct.
So if we continue to have interest rate problems through 24, they're going to either have to reprice or run into some issues.
But yeah.
Yes, sir.
Great job, Mike. You mentioned previous quarter results were maybe a little underperforming. It's been the company's track record over the past couple quarters, and in this time of economic uncertainty, is that kind of an issue?
With regards to
Their
like, just-
performance in terms of street consensus, did you take a look to see, was this a one-off quarterly instance of them missing, or has this kind of been a trend for the past couple of quarters?
Yeah, so if you look at the past, at least the past 3 quarters, they had all beat earnings. I think this is really because like food processing, for example, is performed very well in the 3rd quarter. Commercial food service, where I did a lot of my focus for research, is still performing very well and both having some nice margin expansion. But I guess to the point of like when things go down, it's really hard to tell, right? Because like, so I try to look back in 2008, but they don't give you as much detail about how acquisitions are really factoring that in. I really saw that was more of a 2016 thing where they start breaking out, and that's why in my write-up I do start breaking out, because that's where I actually get the details. So if you look at 2008, if I remember correctly, they do have earnings growth. In 2009, they have earnings growth, but to what extent it came from
So it's just a one-time thing, a one-off, a
Yeah.
one-time miss. Okay.
Yeah, so back to the mentees again. I noticed that supply of power is in your poorest forces, and Middleby has low supply power in that they mainly buy raw materials such as stainless steel and all those elements. I guess the question I have for you is that how do they strategically purchase their raw materials?
I think what we mean by that is just they have such a broad supplier network, and that's part of their strategic kind of idea with their acquisitions. We did see actually with their recent Q3 results that actually hurt their margins. They decreased by, I think it was 1.7%, just because of higher labor costs, higher input costs, as well as just additional costs for, merging these new acquisitions into Middleby's overall operation.
Okay, thank you.
Can someone, I don't know who, walk me through why Exhibit 8, this graph of excess household savings matters, and why I shouldn't be concerned? Because when I take that slope and I keep going forward to November, I think I'm sitting somewhere between 600 and 900. And I'm worried people are going to run out of money soon. So can someone walk me through why this matters, 1, 2, and then 2, like how it fit into your model?
Yeah, so I'm more to use that. I think when I reference that, that's like one of my last sentences.
Mm-hmm.
And I use like kind of the point of people still spending at restaurants, and that's kind of why I referenced the restaurant production index, which just like a broad indicator. Because you're saying it's still going well because consumers are still being able to stomach these higher prices that restaurants are passing on. So that's part of the reason why, I don't know if it's an exact correlation, but I felt like that gave some sort of a solution that nodded you toward the answer.
Did you run any kind of analysis on when they're, in other words, I get, right, if I understand the general idea, starting around beginning of 20, people either through the combinations of stimulus checks people received, or the idea they didn't have to go out, they saved money. And then sometime by 21, as they started venturing outside, we started churning, and now there's, right, we've seen this effect. We're going to hear another pitch today in the hotel industry, not to steal thunder, how people are spending with reckless abandon because they didn't get to go out, and that includes restaurants. Even if they pass on massive increases, they're willing to pay for quality. But my fear is, and this is a long-winded question, did you do anything? In other words, when do you think this phenomenon is going to play itself out, and then it's just back to business as normal? In other words, if that slope keeps up, did you try to make a guess at when the gravy train might end, so to speak, and did you model that in at all?
To be honest, no, I did not model that in. I think, and this isn't a perfect answer, but I think it goes really with like when you have these restaurants performing very well, and I put in that graph of quick service restaurants still opening new doors at a higher rate than they have in the past.
Yep.
I I mean, it's probably not a perfect correlation, but you could say even excess savings for companies because you're passing on more than your cost to the consumer because you ultimately know they're willing to pay more because.
As long as they have more.
Yeah,
Sure.
well, yeah,
Yeah.
so.
Okay, fair enough. And yes, sir.
I think my question kind of goes off that because I noticed you guys included some like proprietary research in terms of your survey. Just kind of what was your thought process behind that and how did you relate that then to your evaluation and like tying that into the pitch?
So my survey wasn't entirely tied into my model. I think my idea with the proprietary survey, it's not even proprietary, it's a survey.
But it is, if you did the
Yes,
survey,
yeah, okay.
it's your proprietary research.
But it was more kind of to affirm the point because so the industry expert that I spoke with, Dr. Valentine, had kind of pointed his way because I had this kind of idea that I think restaurants are really going to have to do something to change the whole labor narrative. And he pointed me his way, but he had really talked about like Gen Z and millennials being this kind of very different kind of consumer, and they really want on-the-go products. Like they don't want to wait. They favor, not going into Chick-fil-A and sitting down and things like that. So it was more just to kind of affirm that point and make sure I was kind of leading myself in the right direction. So.
All right, well, thanks. Very nice job. I appreciate the attention to detail we're starting to see, right, as a program. So no intro music here.
Ryan,
You want to do a little boot box thing? Okay.
Ryan, picture.
Charlie, smile.
Yeah, so I'm Ryan Kreie. I'm a senior in the name program, and today I'll be pitching Wyndham Hotels with a price target of $83.52, representing 17.4% upside. I guess I'll just jump right into my screening process. I was primarily looking for a company that would be a little more recessionary resistant, especially given the climate right now. I ended up kind of choosing the hotels, resorts, and cruise line sector, and then kind of went through each of those companies and found what I thought was kind of a disruptor for the space. So, yeah, I guess we'll open up to questions. And this is Charlie, my mentee.
Hello. And then I guess we can touch on the revenue drivers as Dr. Wong asked. So there's three main revenue drivers. First, is royalty fees as a franchisor. They get about approximately 7 to 10% per room of royalty fees. So it's just pretty steady cash flow throughout their business model. The second revenue driver that we see is that also included in a Fred graph of consumer spending for lodging. And as you can see, year by year basis, there is an increasing demand or increasing spending for the lodging industry. And it's expected to go up by 30% for 2023. And the last revenue driver, as you see, is the select services, where Wyndham has 99% of their select services basically saving more money on less labor-intensive work.
Yeah, we'll open up to questions.
So the first two are, what was your price target originally that you submitted? So how much did it change by?
Yeah, it was somewhere just over $90, I believe.
Okay, so you changed tax rate. Do you recall the other thing that you changed?
Yeah, some calculations into my DCF to get the
I don't like general.
The,
I like precision. Thanks.
The,
While you're pulling that up, maybe.
It's like the sum of the present value and terminal value.
Okay, good. So knowing what you know now, how would you have rewritten the research section of this report? Because
I definitely
one of the criticisms of your director is
I definitely would have included more outside sources, like citing kind of what management was saying, which I did look at. I did absolutely not.
So not just what management says, but maybe what others say, right?
Like,
so for instance, it looks like you did some stuff like this occupancy rate. Where did you get this from?
That chart.
Yeah, well, this came from management. All right,
that's from the management.
All right, how about the next one? Is this one from management or somewhere else?
That's also from management.
Oh, never mind. I was trying to help. let me retry again. What did you do not from management that you see in this report, or we didn't get to see in this report?
So I looked at like industry data on hotels, like the different levels so right, you have economy and mid-scale, which is kind of the lower end of the hotels. You can kind of see on their hotel brands, I think on the second page of my write-up. So economy and mid-scale is mainly where Wyndham falls, and that's like over 90% of their hotels, and then actually it goes up from there. So when looking at metrics like RevPAR, which is revenue per available room, so you take total amount of revenue for the day divided by the amount of rooms available. So obviously, the higher the better because you have less rooms available. And the occupancy rate and average daily rate, so like the rate of the hotel room that you're charging. So when looking at all those, economy and mid-scale had the least amount of volatility and showed the greatest recovery from previous recessions, both like right now compared to 2019 levels and also in the past in 2001 and 2008. So I kind of have some past to back up on there.
Okay. Basil.
Yeah, so Charlie, notice that primary modes for all of your primary economic modes for all of your comps are network effect.
Right.
Which essentially, is that what it means that like they're strategically placing their hotels?
Right, correct.
Okay. What makes Wyndham Hotels different compared to all their peers? And have you factored that into your model strategically, like how they actually?
Yeah. So wait. So can you like repeat that last part again?
Yeah. So what's Wyndham's strategic moat that they're having for the network effect compared to all their peers?
Right. So with how Wyndham is doing it, they place 80% of their hotel placements are nearby 10-mile radius of consumers, and strategically right next to highways or largely dense populations. And so that's where they're capturing most Americans in the United States, and with the modeling of Ryan.
Yeah, so some of the higher end competitors, also why I didn't include, I'll go into this first, so why I didn't include a peer chart. A lot of the luxury competitors are trading at pretty high multiples right now just because they've been struggling a lot more with the recessionary stuff looming. And then kind of to get into the modeling part, I would say that
so is it 8? So there was like 80%.
Oh yeah. So that's more than a lot of the other competitors. They're strategically putting these locations in places where they know they're going to get a lot of volume of people coming in. When a lot of these higher end competitors are like the Hyatts of the world who are putting them all on beaches off and way out on the coast. So they're trying to capitalize more on kind of everyday travel.
Awesome. Thank you.
Yep.
August and Alex.
Yeah. A couple questions here. Your midterm in your box, what years do you use to calculate that?
The midterm rates? 5 years.
5 years, right? Like from 2022?
Yes.
Okay.
That includes this year, yeah.
Okay, that makes sense. And then also with your price target, you multiply it by like a 15% premium. Is that like historically consistent, or is that raised?
Yeah, so they've been trading anywhere from a 10 to 20% premium in the market. So I just kind of put that right in the middle for my base case there. And then obviously my downside is 10% premium and the upside is 20%. So.
And then one more, sorry. If your research suggests that you're bullish on like the hotel industry in general, like why not like Hilton? Like, what makes the stock better?
Yeah, so I see Wyndham as a trade down beneficiary. So when the money gets tight, people tend to, obviously price is kind of one of the first things that people look at. So I see Wyndham benefiting as trade down from obviously higher scale hotels down. And also they, yeah, they're less volatile than like higher end competitors. I just want something that's more of a value play here that's going to be less resistant to recession. So, yeah. Good.
Good job, Ryan. It seems like there's a pretty big transition here going on to capitalize on that. Do you include any like transition risk premium or kind of factor in like execution not possibly going through as smoothly as possible, as well as has this current management team or guess anybody in the industry ever kind of gone through this large scale of a transition, and how successful were they?
So I guess to touch on your second point first, I did factor that into my model. I had 50 basis point risk premium on my WAC for both the transition and some currency stuff, just because they're like 13% is international as well. And then I guess management in the past, I don't think anybody's really gone. I mean, obviously other like Choice Hotels is also kind of going through this transition to more of a select service model, which is based, I don't know if you guys know what select service is, but basically they're cutting back on like giving you new sheets and towels and stuff every day. So you opt in if you want it, kind of thing. So like just to kind of cut back on labor and stuff during the recession, kind of combat some labor shortages and stuff like that. So I think that's fairly easy to implement. I think the bigger impact is kind of what impact that has on customers, and right now that looks pretty good. So yeah, I don't really have anything to base it on in the past. It's kind of a newer thing.
Oh, thank you.
Yep.
Who's next? So, go ahead.
Oh, I thought you were talking about pitches, sorry.
Oh, no, yeah. Do you have a question or no?
No.
Okay, so then my last question for myself is, so you've got this idea that they're recession proof a little bit, right? Mm-hmm. But you're also saying they're benefit because it's a recession. So you can't kind of have it both ways. Which are you projecting, right? If there's a looming recession coming, well, I guess you can, and you're going to say that they are you trying to, I don't want to put words in your mouth. Why is it that they'll be better able to withstand a recession, one, and two, why is it that they won't fall in terms of their growth, their revenue growth, if we are actually going into this recession, so to speak? And then how long will this recession play out? I guess I do have 3 questions. It'll take me a while.
Yeah.
I'll stop for a moment.
Yeah, so I think one of the things that kind of sets Wyndham apart is they have a lot of, based on their positioning, right, by a lot of highways and stuff, they're going to have a lot of traffic that you can just count on coming through. So I think what sets them apart is they have more of a chunk of their customers that they can just constantly count on to be there.
Here's the best way I can ask the question. I got it. I'm going to piggyback off August a little bit in a different way. If I were looking at Hilton right now, and I had this box in front of me on page 15, and I looked at revenue growth for 23, 22, 23, and 24, and it had Hilton in front of it instead of Wyndham, what kind of growth numbers would I kind of see instead of -5, positive 0.5, and 1.5? What do you think I might, just ballpark? I know you're not an expert on Hilton, but
yeah,
right.
So I think
what would I expect to see if you were the person modeling that?
I would say more volatility for sure. So
which way, like?
So I think, right, like you were touching on in the previous pitch, right? Consumer spending went up a ton because everyone wanted to go travel and stuff like that. So hotels like Hilton capitalized on that because they're a little higher end. So all those people with more money are spending, and now that's kind of going away. So that kind of is taking a bigger hit to Hyatt and Hilton.
So 22, I'll see a bigger drop. Okay.
And then obviously when things recover, like post-recession, you'll see more growth out of them.
So why aren't you expecting your company to grow basically at all coming back out? Like, I get why Hilton will take off, but you basically are saying we're going to grow by 0.5%, 1.5.
Yeah, I think I was just being very conservative. Looking at the street, they actually projected no revenue growth next year. So I was actually above there. But
and then how about 23, 4? Do you know where they are or what management's guiding to?
Yeah, so management guided like just under 1%. And the streets got it right around 1%. So again,
okay. So most people, including
most people are very conservative on their estimates right now, just because they don't really know what's going to happen here.
Okay, fair enough.
Kind of the bet you got to make here.
Thank you.
Yeah.
All right. Next up, we got Kevin. Checkpoint. Intro song? No, I mean, play the drums.
Kevin, let me know, because I know my one friend like red dot.
I'll text you. Send it to Kelsey.
There's no science.
All right, so today, we're up here pitching Checkpoint Software Technologies. Going into my screening process, I chose my gigs as like software application. So I dove into a variety of companies, and right away, cybersecurity industry stuck out to me. I know that COVID caused all-time levels of cybercrime, so I just dove into that. Really thought this company was interesting, healthy balance sheet, some drivers that I could have found in like acquisition heavy a couple years ago that performed well. And then looking into the G10 chart, there was some good corporate earnings growth, so that's always good. I adjusted my price target from my write-up. My new price target is $141.71. That's due to the price changing and some my premium increasing on my market multiple. And with that, Caitlin, you can introduce yourself.
So I'm Caitlin, and I'm going to touch on like some of their revenue drivers. Their main 3 revenue drivers come from 3 of their product lines, which are CloudGuard, Quantum, and Harmony. CloudGuard and Harmony are subscription-based services, so companies pay monthly fees. And then their third is Quantum, which is just a firewall that gets installed in the companies with a one-time.
And with that, we'll open it up to questions.
So I'm listening to Dr. Valentine in one ear, channeling in the same question that I'm going to ask you. If you know what you know now, how would you write your research section, which takes up the majority of the page of your report?
Started right off with what I did that was different.
So tell us what that is, right? Because the chief complaint from your director is this just reads like basically an overview playbook of nothingness. So sees no value in what you delivered. So how could we update this in a way that would make it valuable and make it yours?
So I would just start out with the industry research I did.
So yes, be precise.
Yeah,
like,
I was going to get into that.
Perfect, thank you.
Just going into like security operations center industry and looking at the growth of that and how small, medium-sized businesses are really being attacked the hardest.
And how do you know that? I'm going to start pushing back, not in a mean way, because I'm going to try to make sure we follow this, right?
Industry trade journals.
So like, pick one. No, that's not good. Pick any site you look at. Perfect. So you read a place, Sonic Wall, you read a place, and so you would be able to bring that in and kind of say, hey, I think this because of this, right? You're doing good. Yeah. Please don't take it. This is not a criticism. This is meant, I'm trying to do this as a teaching lesson for all of us and beef up what I know you already did. So I wouldn't do this if I knew you didn't do something. Fair enough? Because otherwise it just makes you feel bad.
Yeah.
So so you've got some trade journals that back up some of your research that suggest things. You've got this malware attack game that probably matches management. Did you depart from management or did you depart from the street in some way? I know you say you differ down here, right? You have a CAGR, but so what are the reasons you differ?
So I read a variety of sell-side reports, and really everyone was focused on the billings growth. There was only one, it was BMO sell-side report that even mentioned the rollout of the Horizon platform.
Yeah.
So that's the reason I like singled in on the security operations center industry to see how the rollout of that, targeting these small businesses that are being hit because they're vulnerable because security operations center prices are through the roof.
So why don't you think any of the sell-side people looked into that? They're smart people, as we keep pointing out, right? Do they not matter? Are they material? Why do you think they're material?
Because the total addressable market is huge, and they
how do you know that?
5% my industry research.
So what do you think the TAM is of this area? Ish. Billions, trillions, hundreds of millions? Okay. And what percentage of that does this company historically, or do you think they can catch? Ish. 1%, 10, 5, 100, 300?
They can catch 5.
Okay. And so if they caught 5% of a billion, right? That leads us through to, how's it looking? What's the revenue numbers here? Is it 2 billion in revs for the company, or am I looking at 2 million? I didn't see the scale. 2 billion. Yeah, something I'd appreciate in your boxes is let me know the scale we're looking at. That will help. So now all of a sudden you're dealing with potentially 25% of their revenue. You see how that would make a real powerful lead in for your research? Yeah. Awesome. Thank you. Questions? August.
Yeah, this might be for Caitlin or for Kevin. Like I know in a recession, like one of the first things to go for companies, like their marketing spending, whatever. Like, do you know what the trend has been in a recessionary environment for like IT security? Like, do a lot of companies still prioritize that ton, or like what's the pattern there?
Well, I think recently, since cybercrime is so big, Checkpoint has really invested a lot in their marketing strategy the last 2 years, and I think they're going to decrease that in the coming years, which is one of the. I got a lot of questions on my margins, which is one of the reasons that margins are going to decrease too. Okay. Answers your question.
Basil.
So I know that you just said that like this is like a growing industry. Has their R&D developed tremendously?
Yeah.
While you're looking at it?
Yes, they invest a lot of money into R&D, and that was one of the reasons behind my long-term growth rate being high, because I really think it's a growing industry, and the growth of R&D, coming out with new platforms like Horizon and Quantum Titan. They have around 3,000 employees in their R&D, and that's up from like 2,200 in the last 2 years, I believe.
What does that tech do in layman's terms? 'Cause isn't this, I could be wrong, isn't this the old company that used to put the tags on clothing and you walked out of the store? Isn't that what their core business is for years and years and years?
No.
Or is that a different
This
one?
has
Okay,
been-
sorry.
This has been like a
misremembered.
this company, the CEO developed the firewall, and that's been
Okay,
like the
thanks.
backbone of the business, but now they're.
Got the name wrong. My bad.
That's no worries.
Yep, Alex.
Great job, Kevin. What is their current R&D spend makeup, and how did you have that forecasted going forward? Just given it's not a ton of kind of have constant margins, but an uptick from 21 to 22. So
I have 280 million in R&D for fiscal year 22, and that is 12% of revenue, and I keep that pretty constant.
And how's that compared to historic?
It is the average of the historic. It was 14% in 2020.
Did you look up any patents by chance on Google Patents and see if they have more or less or the same number of patents over time?
I did not, but they have 75 current patents and 30 patents.
Nice.
Going through the process.
August.
Yeah, in my last question, you mentioned a decrease in marketing spend, but your boxes in the midterm don't have any margin expansion. Is there like an incongruency there, like what would cause?
Where are you spending the money that they didn't spend on marketing? If I could translate slowly.
Yeah, on marketing, yeah.
If they dropped marketing, they had to spend on something else.
That was on R&D, I believe.
You just sold us R&D's constant.
I'll look into it and get back on that one. So I'm not sure right now.
Thanks. Yes, Max.
Can you touch on some of the details surrounding the subscribers, how you kind of forecasted like reoccurring revenue, and how long are most subscriptions? What's their retention? Can you talk about some of those stats, please?
Yeah, definitely. Management really doesn't disclose much information on that. I know that 48% of their revenue is from their top 10 customers, so I couldn't really find a subscription rate or like a churn rate within their filings. That answers your question.
Do you know how long most subscriptions are? Like a yearly?
Like yearly contracts.
Thank you.
Basil, then Alex.
Yeah, so I noticed that your company is headquartered in Tel Aviv, Israel. And I noticed that the USD to shekel has decreased tremendously past month. Have they been doing anything to hedge?
Yeah, they have. So 46% of their operating expenses, 30% of that is in Israeli shekel, 16% is in euros, and they currently have 155 million in hedges against both of those. Awesome. So I guess that factors back to where some of the money is coming out.
Alex?
yeah, this question is for either Caitlin or Kevin here, but the space has like a lot of big players. You kind of listed like Cisco, Palo Alto, Fortinet. I can think of like CrowdStrike as well. How does Checkpoint kind of fit into that space of a ton of players?
Yeah, so that's kind of what I was saying earlier. They've been known for their firewall products, and now they're expanding their broader portfolio. And I think one way that they really differ is their Harmony platform, which is like for remote workers for unified security, and then also going back to Horizon with the ease of having other checkpoint products, having that as the backbone of all your operations and looking at attacks coming in day by day, it just makes it so much easier for businesses.
Okay, we got
I can
pitched
add on to
in.
that.
Yeah, I was gonna say, either right on there, I'm gonna throw you something.
I also know Quantum Titan is like one of the first autonomous, like to stop cybersecurity attack. It like automatically does it without having to like go through a whole, usually takes 5 months and they can do it in 5 days. So it's like one of the first autonomous.
Is that one of your modes?
I have it as high switching costs, just because when you have all of these things, you have all these products, it's going to cost them way more time and money to switch to a different company, and they continue to come out with new products. So it's more advantageous for companies using Checkpoint to keep adding their products too.
So based on all the work you did, I want to let you say, what is the most important thing we should learn about this company today? If you had one thing that you could teach us.
I would say that it can, like I think they're ahead in the space because they continue to like revolutionize products. And I think they're like ahead of competitors in terms of like figuring out like what the newest like cyber attack will be and how they can defend against it.
Other questions? Thanks. Last but not least, we have Owen and Jackson pitching us alarm com. Did you have music you wanted us to play? Do a little dance on the way up? We don't have music.
Is the baby bigger yet?
No, we're still really little. Yeah, they're good.
Prepare to be alarmed.
Owen, picture.
Wow.
Hi everyone, my name's Owen Filbin. This is my mentee Jackson. Today we have Alarm Holdings, ticker ALRM. So I guess to go on the screening, like recently how we've been kind of constrained to like a subsector of a gigs category. So essentially what I did is I went through the EPS and coefficient of variance like document, and I tried to find a company that I really that I still like that had a large variance, and I kind of narrowed it down to a couple that had buys and holds and sells, because then that kind of can create some variance then or over consensus, which is what Dr. Valentine's been stressing. So I found Alarm, and then just to kind of clarify something, we still think it's a buy. We lowered our price target to $3 to reflect their earnings that came out yesterday. And I think their litigation is a lot of noise. The revenue drop is pretty immaterial. It's only like 4% or 3 to 4%. And that I even think is a little too aggressive, considering when you take out Vivint revenue, it's 14.7% of revenue compared to 14.57% of revenue. So that's kind of where we stand on our downgrade, but we still think it's a buy. So if anyone has any other questions, I'll be happy to answer.
My first question is going to be the same as always. Knowing what you know now, the research section's half the page. How would you have rewritten it?
I would have started with our industry report that we looked at. So I would have started the first line with our research from the STM State of the Market report, and then kind of go into what we found, because that kind of is the most direct starting point.
Okay, thanks. August.
Did you use the whack in your box or your price?
Yeah, sorry, I don't know if you saw it. So the whack in the box was referenced to my whack, it was to a different cell. So the one that's correct is the 8.07.
Okay.
So kind of more what you were looking at.
Jake.
So I just pulled up like the G10, Valentine's favorite. I'm just wondering why, or what do you think you're different from consensus, or where you are different, because they're kind of back at 2020 levels for their next 12-month EPS estimates. I'm just curious what you see
In terms of their 2022 estimates, because we're above consensus going forward.
Okay. But so, I guess what is driving that in your view?
Even so with that I get that's valid. So our research, we found that their commercial SaaS, they have 5.5 million commercial locations as opposed to 2.9 residential. from each commercial location, they get 6% higher ARPU, which is revenue per unit. So the best way I can describe that is like, if you're a home who has one alarm product versus like a, I don't know, Marquette, they'd have way more products. And we actually broke down, or I tried to break down the cost, or like the margin per unit. I did my best because they don't disclose the COGS per unit. And we found it to be like $15 per unit for a commercial, as opposed to like $7. So it's kind of right on par with what they're saying. So that was our critical factor, and that's kind of where the bulk of our research came from that 2022 SDM State of the Market report. Alex.
Yeah, I'm sorry to keep harping on the G10 chart, kind of going off of Jake. Seems like since your write-up, consensus has lowered estimates by about 20% for EPS. And I know you've reiterated kind of that confidence that you have that's not material, but I guess like usually like stock prices following earnings revisions, is this like a one-time thing for you, or do you think that alarm is going to have more of this legal troubles and kind of dragged out?
Yeah, so what I'll say is I had planned on lowering my price target kind of before I looked into this too, because I just thought some of my assumptions were a little too aggressive. So I guess not timing on that front. They have noted that they've had legal disputes with Vivint, and in their last earnings, they kind of made it seem like they don't even want to like be with Vivint anymore. They like said that their partnership's kind of choppy. But yeah, they've had limited drops in earnings, and a lot of them are kind of these like $20 to $25 million hits, and they last like a year, and then that's kind of it. So I don't think it's very fundamental to their growth or anything like that. I think it's a lot of noise. So yeah. Basil.
Yeah, so I noticed that one of your operating segments is residential. Can you just talk about how the housing market affects this?
Yeah, so that's another area where we've been different from consensus. A lot of sell-side analysts have been talking about the housing market and new builds. Alarm earns 4% of their revenue from new builds. So if you're building a new house and you get a full suite of alarm products and offerings, that's only 4% of their yearly revenue. So I kind of took out, my takeaway from that was like, just because the housing market might be choppy right now or not at like rates and such, that's kind of not essential to their business.
Yeah.
So, I mean, take that for what it is, but that was my takeaway on that.
Okay, awesome. I got a Kevin for a question for Jackson. So I noticed that intangible assets is a big economic moat. Sorry. How do they differ compared to all their peers? Like, what's their main strategic standpoint when it comes to their intangible assets?
So I think the biggest thing with alarm.com is the cloud-based SaaS, software as a service, service. A lot of the companies, they offer the same sort of applications or enterprise applications. They don't exactly offer the same sort of congruence between all of the devices that you would have. I mean, alarm.com can be a one-stop shop for a company or a house. They have the hardware products, they have the licensing and the services that you need, and they have the cloud-based where you can integrate all those things together. So I think really it comes down to that cloud-based where you have everything on one network. It's super easy to use, and that's how they can be better than their competitors.
Alex.
Yeah. I don't know. I guess my question is, if you're like below consensus, earnings are revised down, margins are contracting, what do you want to sell for this?
Well, I guess I'm still above consensus. There's kind of some crazy analysts. All right, no, I shouldn't say that. There's some very bullish analysts out there. So when you see the consensus estimate, like that's not really like when you take out. There's two outliers that are like $90. So when you take out the majority, I'm well above, or not well, but 15 to 20% above consensus for both my price target and my earnings. I have not looked into what I will sell. I should have, but I haven't. So I can follow up with you, but yeah.
Alex?
This might end up being for Jackson, but kind of walk us through Exhibit 7, the alternative research into crime correlated to smart security, and kind of, I guess, what were your findings? How did it factor into your model? Looks pretty cool.
Yeah, so I didn't factor in my model because I kind of wanted it to just be kind of like food for thought. But so I went to the FBI.gov website, tried to find like multiple years of data that relates to like crime, because that's like when people think of like security systems and smart home applications, they think of crime. That's obviously why you get it. So what I found was that 2015 and 2019 had Excel databases to like manipulate the data. So I used those 2 years. It compiles every metropolitan city in the United States. And then I used burglary, theft, and then motor vehicle theft. And I found that crime really isn't doing, well, it's decreasing for all those, but my takeaway was that like, I think their customer base is kind of not like focused on crime, but I think they're using these applications for broader reasons other than just crime. And that was kind of like the housing market. A lot of sales analysts talk about like crime rates, and like I kind of just think it's not like it doesn't correlate, but I don't think it's as like direct as some people make it out to seem.
Cool. So a couple of questions from myself and Dr. Valentine. One, it looks to me like their acquisition of market growth is starting to stagnate. Just like they kind of replaced ADT, and ADT grew for a while and then kind of flatlined. Their last couple quarters of market share growth are almost flat. All their growth is coming through them increasing their prices. Meanwhile, you've got Amazon and Google offering competitive DIY price platforms that are growing monstrously in terms of market share.
Yeah.
So one, why am I to believe they can just continually basically increase their prices forever and not lose customers? When all these other folks are grabbing pieces, right?
I figured that was going to come up. Yeah. I didn't add this to my report, and I should have. I looked into the DIY component, and I looked at a lot of firms that could offer DIY, and it's not as streamlined as what Alarm can do. So like at the end of the day, you really need to know your stuff when you do a DIY. And even that's mostly residential. So for a commercial property, I'm just gonna use Marquette again. If they were to do DIY, it would take like a lot of manpower and like investment to actually get it up and running. So I think that whole DIY thing doesn't really work. Maybe for ADT because they're more residential, but commercial, I don't think that really holds up. So I guess that's the answer to that. And then in terms of acquisitions, they haven't made. They actually did make one recently of Moonlight, but yeah, they haven't really indicated much of that.
Okay, and then two, we've got EPS growth out to the horizon of what, 8%, 5%? What are you doing kind of as we go out 3 or 4 years?
It's are you talking about for 2024 out?
Yeah, 24, 5, 6, I don't know.
6%, yeah.
So again, if we look at Dr. Valentine's model, it looks like we're paying a premium. We're paying near a high in terms of market multiples for 5-6% growth.
Well, I decreased the multiple because I think that it was a little too high for now, and then my projections of earnings are higher than the street. So
right, but I'm looking at his G10 chart, right, and I'm looking at the long-term market multiple, and it looks to me like we're paying what, 1.6 times the number.
Well, 1.8 times.
Okay, well, even worse, 1.8 times the norm, and we're paying a premium for not premium earnings power. Why should we do that? Like, there's a lot of really good value stocks available to us that have the potential to grow their earnings better. Why in the world do I want to buy something that grows 5%?
Well, it's not 5%. It's actually more like 9%. Sorry, I was looking at the wrong number. And then also some of that 9% is tied up in the 2022 and 2023, where I do factor in some litigation stuff. And then I start to realize their commercial SaaS with these 5.5 million.
So like, what's the growth rate in your terminal year on EPS or the year before?
8% for terminal year, and then revenue.
Well, it's a similar question, right? Even if I'm getting 8% growth out in 25, I've got a lot of stocks that have been pitched to me today that are able to grow in the teens, especially in a high interest environment. And I don't have to pay a premium relative to where they trade.
Yeah.
Why should I pay a premium for this in a economy that looks like it might be starting to recover? but I got lots of other things I can buy with superior earnings power.
Yeah.
Why buy
Sure,
yours?
yeah, I should probably lower it.
No, I'm not, no,
Oh,
don't
is that-
concede to me, I just wanted, if you had a reason, it's okay.
I mean,
But yeah, no, that's the part that is the question.
my hunch was that like,
Yep.
I do agree that their P right now is really high considering their earnings are kind of low.
Yep.
So yeah, I agree with you. I think it's a little misleading. So maybe I'll revisit.
It's not a misleading thing, I'm just saying it's a question, it's a legit question if we're running a portfolio. And your answer could simply be, this is even though that's true, Dr. Wall, in my sector, this is kind of the cheapest, best value that I've got for it. My sector has withstood the recession well, they tend to be high priced, and there might be other sectors that are a better buy than mine, truth be told. But in my sector, this is the best I got for you. If that's your answer, it's okay, but I'm not trying to put words in your mouth, but that's kind of right. That is the issue we're running into. We've got a thing that's got a pretty high price relative to a lot of other things we've seen that aren't in your sector. Yeah. So that's what I'm trying to help.
Yeah.
Does that make sense?
Yeah, I get that.
Yeah. Okay, cool. So this week, did we have any non-buys? I thought they were all buy pitches.
All buys.
All buys.
I need you to actually do your job seriously. Turn off. Thank you online for everyone. Tell me when you're off.
Yours.
I have charged Dr.